Hello, fellow investors, and welcome to Finance with JCL. Today, we're going to be looking at FedEx, looking at the numbers, and I will share my valuation at what I think their shares are worth. The ticker symbol for FedEx is FDX. Just before we get started, I'd like to position this in the context of the channel. So that the roadmap for the channel is there are 6 key stops. So you start off with personal finance. And the red stuff, once you've kind of mastered that, you've got a budget, got money to invest, then move to the investing terms and key principles of investing. Once you've mastered those areas, then move to the investing tips, and you can see that the red card's in stop number 5, which is the company reviews. So I'm going to build up the library of content over time. But the fact we're at company reviews essentially assumes that if you're going through this video, you've got some prior knowledge of key principles of investing, the terminology, etc. So that's the roadmap for the channel where we are today. Now there's 4 key assumptions before we start. The first is that you are in a position to invest, and that if you are going to do that, you'll take your own decisions and take professional advice, and not just invest in FedEx because I've highlighted it. The next thing is that, to be clear, this is not investment advice, it's for educational and entertainment purposes only. And for full disclosure, I do not directly own any shares in FedEx. Possibly one of the index trackers I'm in own shares in, perhaps indirectly I do, but I don't directly own shares in them. Cool, so let's have a look at Morningstar, which will show the 10-year view, and I'll highlight some key points. So here is Morningstar on the screen, and a quick look at the financials will indicate that the revenue from 2011 on the left to the trailing 12 months on the right has almost doubled in around 10 years. So you're looking at around about a 7% per year revenue rate of growth. The net income, however, has been quite variable. That net income was 1.5 billion, and it's now 2.5, but it's been up and down in between since. It looks like 2019 and 2020 weren't particularly hot years for the earnings, and then that kind of translates to earnings per share: $4.57 in 2011, $9.19 now, but it's certainly not at a linear growth rate. You've had 16.79 in there, you've got 2.30 the year after, so there's quite a bit of variation. Dividend, however, is excellent. It's increased for the full years, 10 years in a row, from 48 cents to 2.60 2020. And that's a nice gradual increase, and the payout ratio is always below 27%, 21% in the trailing 12 months. So there's room to grow that dividend once they stop growing the organisation. And we're interested in cash flow, and that has operating cash flow doubled from 4 billion to 8 billion over the period. But there's been quite a lot of capex spending in that, so the free cash flow is variable and negative in some years, including for 2020. The most recent figure for that is 2.8 billion. Key ratios wise, current ratio is always fine. It's always above 1 and below 2, 1.76 in the most recent quarter. And the debt to equity was 0.11 in 2011. It's crept up all the way up to 1.72 now, so it's getting a little bit high. Then finally, on the profitability side, the net margin is thin. Only 1 year it's above 5%, and it's 3% for the trailing 12 months. So it's a very competitive industry, low margins. The return on equity always seems to be quite reasonable, apart from 2019, and it's 12% now, but that's generally been okay over the period. And then your interest coverage is dropping down, and it's 3.48 for 2020, which is a bit lower than I'd prefer. So those are the key highlights for me, what I'm looking for, that initial view of the financial statements. Now, looking at Yahoo, and I look at the analyst page, just to get an idea, and it looks like the growth estimates, for the past 5 years, it's like 14%. Going forward, it's saying double that, 28% for the next 5 years. So it looks like a very high growth assumption there, and they're thinking good things are going to happen. And then The very last thing I do is look at the price once I've been through everything, and looking at the price, the stock was down below 100 in March this year. It did hit 300 in December. So you could have trebled your money had you purchased the stock near the bottom. Now it's easy to say that, and it's very hard to actually execute that. I suppose in hindsight, with people, lots of shops shut, people working from home more, people not allowed to leave their homes in many areas, certainly here in the UK, and I'm sure in areas in America, for example. E-commerce going to increase, and therefore FedEx will be delivering more packages. I guess that'll be the assumption around that. And e-commerce is going to increase going forward as well. So that's the situation. So now I'm going to have a look at Simply Wall Street very briefly. Now you can see here they've got a fair value of 165, so they believe FedEx is significantly overvalued, which is an interesting indicator. So over to our summary, and I've done a bit of a RAG status here, red, amber, green, just to give you a bit of an indicator of how the different areas are looking. So revenue increasing, 75 billion now, and it's been beautifully increasing over the last 10 years. That's definitely a nice green. Earnings have been variable, so it's amber as we saw, and so is the free cash flow. That's been pretty up and down, so that's also an amber. Total equity has always been fairly decent, so it's kind of a light green. It's 12% at the moment. And the dividend position's good, although it's not a massive dividend, it is increasing, and the payout ratio is low, so that gets a nice green there. Current ratio steady, 1.76, so that is it green, so they should meet their short-term obligation. The debt to equity, I'll put that as amber because it's increasing and it's getting towards 2, which I don't really like. And therefore, the interest coverage is 3.48, and that's getting worse. That's a red. That's the only red. The industry, e-commerce is growing massively. These sort of distribution companies, logistics companies are important, and the market will be growing. However, it's a very competitive sector and very kind of susceptible to big increases in fuel costs that could hurt the margin. Although the industry is growing, there are a couple of negatives, so I'm going to balance it out as an amber. The moat is, it's steady. I think everyone knows FedEx. They've got a good network. I've put it as amber, but maybe that's a bit harsh, perhaps borderline green. There's no kind of value in the price to book. It's 3.3, and the book value has been increasing though to 80, so they've been increasing that nicely. So that's a green. And the PE ratio I put as amber because it's 29, which is a bit higher than I prefer for companies, but the forward PE ratio is actually 14. So based on the growth that's expected, could be 14 potentially in 5 years' time. And that looks pretty good. So maybe a bit higher now, but it could improve going forward. And the Peter Lynch category, I struggle in which one to put this in, but I've put it in the stalwart category out of his 6 categories. It's not a slow grower for sure, but it's not one of those hyper fast growers. Stalwart's kind of a medium grower, good name, been around a long time. I don't think it falls into the kind of turnaround or asset play or cyclical. So there we have it. That is the overview. So you can see there's a split between quite a lot of amber and a bit of green. So it's fairly decent, but it's not the best company I've seen. So for me, looking at that, I'm not expecting it to come out amazingly on the valuation, but let's have a look at that next. So the valuation is, I take their free cash flow number that I think is a good representation. I estimate the 10-year growth rate. I then calculate perpetual ongoing growth rates. That's generally sort of 2 or 3% GDP growth rate. And then I apply, for this one, a 10% discount rate because I want a 10% return. That's what I'd ideally like to achieve. With all that said, that means the intrinsic value is 243 according to my calculations. It's higher than the Simply Wall Street number. That's how I've done it. Price when I did this was 264. It's pretty similar. So essentially you're buying it, broadly speaking, at intrinsic value with no margin of safety. From a value investing perspective, it's definitely not a buy because there's no margin of safety. In any event, there are better companies out there. I'd rather buy Banco ZK than this one, for example. However, in the short term, there could be a view that says that there's going to be vaccine distribution needs in many countries. E-commerce is increasing. The analysts are saying 28% a year growth for the next 5 years. Is that worth perhaps more of a short-term play for the next year or two, where the share price could potentially increase further based on the earnings growth? Yeah, I think someone could make money from that. I'm not going to do it myself, but there's definitely an argument for it in the short term. And with that current ratio, you know they can meet their obligations for the year at least. It's worth having a look at, I think. So that concludes my assessment. I appreciate you joining me today. A quick one for the UK users out there. Got a Quidco cashback link, which is a gateway to online shopping, and you earn cashback for purchases you make. And also a link for Numerous, which is a new business that I've invested in. And this business is one whereby you share optional data of your choice, and you then get tailor-made offers with discounts or cashback there. So you could get some TV offers or phone contract offers, for example. And for the wider audience, I'd really appreciate it if you're liking this kind of content, if you could hit like on the YouTube video if you're watching it there. And if you want to see more of this kind of stuff or participate in the roadmap that I referenced at the start, if you hit the subscribe button, the alert bell, you'll get notified of the future videos that I put out. But drop a comment below. Let me know what you're thinking. Have you bought FedEx? Would you buy it? Have you in fact sold FedEx when you bought it on the nice run that we've had this year? That'd be pretty interesting to hear. A shout out to anyone that's looking at the Patreon site. If you're a VIP patron, you can get a shout out at the end of my YouTube videos. So thank you all for taking time out your day to join me on this one, and I look forward to seeing you on the next one.